Hello, welcome back to Commerce Masters. We have been discussing tools of technical analysis, and I have already told you that we have 6 tools for technical analysis, and the fifth tool is being discussed now. I have already explained what is oscillator. The fifth tool is mathematical indicators, and in mathematical indicators I have already told you that we have different types of mathematical indicators, and we have already discussed what is moving average, simple moving average, and exponential moving average, and all these things. And the second mathematical indicator was oscillators, and in the last class we have discussed what is oscillators and the meaning of oscillators and the types of oscillators or the tools in the oscillators and how we calculate what are the different oscillator tools we have already discussed. And the oscillators, as already discussed it is a market it is a mathematically derived measure of a market momentum, and I have explained, I have told you what is a momentum, what is the momentum of the security. Okay, these things we have discussed in the last class, and the first tool was rate of change indicator, and that too we explained, ROC. Okay, and we have already completed one example of ROC and all these things. And today we are going to move to the second technique, mathematical indicator oscillator, that is RSI, relative strength index, or it is also called momentum analysis. In the last class we explained what is ROC was a mathematical indicator, or it is a technical timing momentum oscillator. In the last class I told you the rate of change is a technical timing momentum, and I give you one example. It is the price, how the price moves from one time to another time. In between these two, it may be 1 week. In the example I explained to you, in 7 days period, how this prices moves. Like that, I gave you one example. So the 7 days was the band. In between, these prices moves. So here, what we are going to explain is, it is not a timing. The RSI or relative strength index is not a timing momentum, or the technical time, it is not a technical time oscillator, but it is the momentum analysis, or just a momentum analysis, just to know the increase or decrease, the rate of acceleration or rate of deceleration. This is what momentum I explained to you. So here we calculate, here we measure the momentum. What is the momentum? Okay, so it's the relative strength index is a momentum oscillator that is able to measure the velocity and magnitude of stock price changes. Okay, and the momentum is calculated as the ratio of positive price changes to negative price changes. You got the idea? Here, what we calculate is, we calculate or we measure the positive price, the ratio between or the relation between positive price changes and negative price changes. So what we have to get? We have to get a positive price changes and negative price changes. You just see, the relative strength index measures the share's internal strength or weakness. What is internal strength or weakness? The internal strength or weakness is measured by comparing today's price to its previous day's price. That is not time band, but we are comparing today's price with previous price, yesterday's price with today's price. So we can understand whether the price has been increased or price has been decreased by the demand and supply forces. So here, what it measures is, it measures the strength, the weakness of the security. Okay, that is measured through the price changes. So it does not show the strength or weakness in comparison to other stock or shares. It measures the strength and weakness of the security internally, not with externally. We cannot compare the relative strength index of one security with related RSI of this another security. This measure is not used for that. This measure is used to understand the internal strength or internal weakness of the security. And once we calculated RSI, you just think, once we calculated our RSI, that is relative strength index, we can compare this with some values. These values have been, the ideal values are this, are like current ratio. You know, the current ratio is 1:2, like that. Ideal ratios are there, like that. Here in RSI also you have some ideal ratios, ideal numbers, and we compare the RSI we calculated for one security with the ideal numbers. That is, the ideal numbers are like this. For neutral value, the ideal number is 50. Okay, that means the security prices are moving neutral. And if the RSI is 30 or below, that shows this security is oversold. This security is oversold. The demand of the security is very less. The demand for purchasing the security is very less, but the supply of the security is very high. So the price of the security will be reducing, will be decreasing. Okay, so oversold situation will be shown by the number 30, and if the number is 70 or above, that shows the security is overbought. Okay, so we can compare the RSI of one security with these numbers, and I will tell you how this RSI is calculated. You just see RS. First we calculate RS is relative strength. Okay, RS equal to average gain per day divided by average loss per day. Okay, then once you calculate RS, you can calculate RSI by using this equation. This equation is RSI, relative strength index, is 100 minus of 100 divided by 1 plus RS. Okay, so the only thing here you need to calculate is the average gain per day and average loss per day. How do we calculate average gain per day and average loss per day? See, I just give you an example. And calculate RS out of it. The days 1 to 15 days. So here in the problem, in the example, you are given 15 days closing prices of the security, of a security, okay, of any security. The closing prices of first day was 20 rupees. Closing price of that security in the second day was 22 rupees, and the closing price of the 15th day, and all the days in between this have been given, you just see. And the closing prices of the security in the 15th day was 38. Okay, here by using these closing prices, you can calculate, you can measure what is the gain of the day, what is the loss of the day. Okay, you just see the gain and loss of the days. In the first day, you cannot calculate, you cannot measure the gain or loss, because that is the price of that day. You cannot compare it with the previous day because you do not have a previous day. In the second day, you just take the second day. The price of the security, I will tell you, the price of the security was 20. Okay, you just see the price of the security was 20. And the second day, the price of the security became to 22, increased to 22. So what is the gain of the day? The gain of the day is 2. There is no loss because the price have been increased from 20 to 22. So the average gain is 2. Okay, in the second day you just see, in the third day you just see, the third day is compared with the previous day. Okay, with the second day. So in the third day, the price of the security is 26, and the price of the security was 22. So the price has increased from 22 to 26. That is rupees 4 is your gain in the second day. And in the third day, 1 rupee has been 1 rupee decreased. So you just see in the loss it is 1 rupee. In the fifth day, from 25 to 27, 2 rupees increased. So 2 rupees in the gain. And in the sixth day, from 27 to 24, it is 3 rupees is the loss. So 3 rupees is the loss. Like that, every day you can compare with the previous day, and you can just see whether there is any gain or whether there is any loss. So you will get gain of the day and loss of the day. And once you calculated the gain and loss of all the day given to you, you can take the total, you can sum it up. So the total gain is 27. Total gain is 27 and the total loss is 9. So 27, your total number of days, though your total number of days is 15, you cannot take the first day. So you take only 14, not 15, because the first day is not taken. Totally we have taken only we have calculated loss or gain only for 14 days. In the first day there is no loss or there is no gain, so we are not taking it is for the calculation of average. So 27 upon 14, 27 upon 14 equal to 1.93, and that is the average gain. And the average loss is 9 divided by 14, 9 upon 14 equal to 0.64. This is average gain and this is average loss. Average loss is 0.64, average gain is 1.93. So here you can very easily calculate your average gain per day and average loss per day, and hence you can calculate your relative strength. So relative strength is, here your relative strength is, it is calculated here, 1.93 divided by 0.64 equal to 3.01. And you can calculate your RSI by using the equation I have already told you. Given the equation here, RSI is equal to 100 minus 100 divided by 1 plus R. So that is that equation is applied here. This is it, RSI equal to 100 minus 100 divided by 1 plus R. 1 plus R. RS is calculated 3.01. So 100 minus 100 divided by 1 plus 3.01 equal to 75.7. These RSI can be compared with the ideal numbers, that is 50, 30 or 70. And if the number was 50, we will tell that this security is a neutral security. The gain and loss, average gain and average losses are almost the same. So the security do not have such, it is neutrally sold and neutrally bought. If the RSI was 30, you can say that the security is oversold. The demand of the security is very less and the supply of the security is very high. So the average loss of the day will be very high. Average loss will be higher than the average gain. That's why you get number below 50 or 30. And in our example, you got the number as 75.7. So you compare it with 70. So as this number is higher than 70, you can say that this security is highly demanded. The average gain of the day is higher than the average loss of the day. Okay, the values are above 70. So it is considered as overbought. You got the idea? So this is RSI, relative strength index. This is another measure for oscillator. So here you can see the momentum. The momentum is increasing. The rate of change or rate of acceleration is good. Rate of acceleration or deceleration is momentum. Here you measure the momentum, the value of the momentum, and internal strength of the security, the internal strength and weakness of the security. This security is very strong, you can say. This security is very strong because the value of the security, the RSI, the measured value of RSI is more than 70. So this security is overbought. So the demand of the security is very high. You can blindly buy this security. Okay. And the next measurement, the third measurement of oscillator is moving average, convergence, divergence. We have already discussed the two measures, that is, one is ROC and second one is RSI, and for both these methods measures. I have given you an example too, and read that well and study that well. It may be asked for exam. And the moving average convergence divergence is the third measure of oscillator, and this is you need to know the meaning of this. We are not going for the problems and all. This is a very complicated measure, so we do not actually it is out of your syllabus. I am just giving you the meaning of it, that's all, so you just understand the meaning of it. Moving average convergence divergence is called MACD. It is an oscillator that measures the convergence divergence. Convergence means coming to it, and divergence is coming out of it, between two exponential moving average. In the first example, the first mathematical measure, we calculated how to measure exponential moving averages, and here to understand whether the movement coming in and coming out means increasing and decreasing. Okay, coming in and coming out, that is increasing and decreasing. So here convergence divergence we calculate using MACD. Here what you do is you will calculate the exponential moving average for different days. One is short-term exponential moving average, and one is long-term exponential moving average. That means, for example, you calculate 25 days moving average, exponential moving average. You take 25 days security prices and you calculate or measure the exponential moving average for 25 days, and you get one number, and then you will calculate 12 days or 11 days exponential moving average for the same security. Okay, for the same security you calculate 11 days exponential moving average, so you will get short-term exponential moving average. So you measured two moving average, exponential moving averages for the same security. Okay, first you took measured 25 days exponential moving average, and then you measured 12 days exponential moving average. And if you calculate the difference of these two moving averages, you can understand the momentum or the how it moves, how the security moves. You can understand this different, the value of the differences between short-term EMA and long-term EMA represents MACD. Okay, this is it, and we are not going for the examples, the practical examples. You need to know only this, and you can just take the notes, and in the Google you will get some examples and some crafts also. You may just take down to the notes. That's all for today's class. Thank you.